Good evening, traders. This is Corey Rosenblum, and you're watching the Theo Night video for September 20th, 2018. And we're talking stocks at all-time highs. Now, not all indices are at new lifetime highs, but as we can see, the S&P futures continued the uptrend to make a new high today beyond our 2920 level. Let's pull back quickly to the weekly chart to get a broader perspective. The last time we had a major pullback was 2015 into 2016, and then of course the high volatility period we still remember from early February 2018. Other than that, the stock market has been on a tear, has been bullish, making continual higher highs and higher lows on rising moving averages. And we'll take a look at, again, the indices, where we are, what we're looking for, and then focus on sector activity in tonight's report. So again, the S&P is pushing up to the 2940, 2950 level. That's our continuous contract futures. The NASDAQ is not quite there yet. It continues to trade within our bearish rising wedge or consolidation pattern. And that's right now in the 7600 level. And that's down from the 7700, just keeping the numbers simple here, from August. And that is bouncing up as expected from our lower trend line and 50-day moving average. The big surprise this week has been the Dow. The Dow futures have taken us on a big bullish break away from our 26,000 level through 26.5 and now 26.8. And that does finally take us beyond the 2018 highs to keep this uptrend going. We still have wider ranges and wider swings, but nonetheless, this Dow, fueled up in some large part by financials and other names like Caterpillar, has taken this to a new contract high. And the Russell, just like the NASDAQ, is a little bit shy of its August all-time high, and that's 1750. It is bouncing up away from our 1705 level pivot to keep all these bull market trends in motion. And that's the broader picture. Again, uptrend, higher highs, higher lows, rising moving averages, and a sequence of bull flags for the moment. And of course, rising trend lines. Let's take a look at our sector behavior. The general thought process here is that we take a look at what the market is doing and then drill beneath it to our 9 sectors, because those, think of those like columns that are holding up the market. The idea is to find strong sectors, find weak sectors, and if we think the bull market's going to continue, try to play position, swing or intraday, or with option contracts 30 to 60 days out in the direction of the prevailing trends. Concept is that which is strong tends to get stronger. Starting left to right, we have our financials. And the financials we typically focus on quite frequently, but they're not at all-time highs. So that is something to keep watching as the markets push to highs. They're doing so without the XLF. Some financial names, think JP Morgan, are at the highs, but others, think Goldman Sachs, aren't quite there yet. Nonetheless, it is trading above a rectangle pattern at about 2850, now 29 on the XLF. Our technology sector, XLK, think of it like the NASDAQ. It's not quite there yet either, but neither is the NASDAQ. It's trading beneath the 76 per share pivot, pushing off 74. We do have a persistent uptrend in motion. We'll go ahead and update our trend line and just keep this higher high, higher low pattern in motion. Like the technology, or like the NASDAQ itself, the technology sector is within a rising parallel trendline channel. I think this is the most surprising thing of all the market here. It's the XLY, consumer discretionary. We can even pull that to a retail. XRT is our retail name. We've covered this in some other Theo Night videos. And we do see higher highs, higher lows, and strength within the retail sector. Now back to the XLY, because we compare our sector spiders. It is making new swing highs, and it continues the uptrend. Think retail, think discretionary, and think names that get strong in a bull market and rising economy. XLI Industrials, just shy of their high, But look at that strength. That's persistence of uptrend, even stronger than some of our other names. Take a look at the comparison in financials, right? Down and then up, up, up. So we've seen industrial names, think Caterpillar, strong getting stronger at the prior high. Materials, we don't really trade those a whole lot, but nonetheless, they have been in a consolidation like financials. We can sort of compare those two and have been breaking out. Energy, think oil and natural gas and others. So those have been in a persistent flag or downtrend from the high. That high was achieved, roughly speaking, in May, and the market has not achieved those levels since. Those are what we consider offensive or risk on, bullish, if you will, sectors. And if these are doing well, the thought process is bigger funds, bigger players are rotating capital into sectors that should outperform in a bull market. This is what we don't want to see if we're bullish, or maybe what we want to see if we're bearish is strength in our defensive sectors. Sectors like XLP, which is a sister stock or sister sector to consumer discretionary. XLY. XLP is staples. Now it's not at the high. It peaked roughly in January and has been on a downtrend with a pretty stellar mid-year recovery to the 56 level. But again, it's not at the highs. XLV, I think beyond retail and XLY, this is the sleeper sector. We've been talking about it quite a bit, but probably not trading a lot of positions in it because we don't trade names like Blue Cross, Blue Shield, Aetna Healthcare, those sort of things. It's XLV Healthcare. I'd probably recommend continually taking a look at some of the names in the XLV sector ETF. U is utilities. How do we know this bull market is real? Because recently, when the market was going up, 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 utilities, XLU, we don't talk about those enough either, were on a trend day down. So XLU utilities are pushing away from the 54.50 level while the equity market makes new highs. Again, compare this on a daily chart or an hourly grid for more information. So we do have strength, and the biggest sectors are going to be technology, Y for retail or discretionary, I for industrials, and then V for healthcare. We can trade these ETFs or look to trade individual stocks in uptrends or flags or fades or trades, however you want to play these positions, from this sector grid or taking a look beneath the market. This is Corey Rosenblum for your TheoNight video for September 20th, 2018.